Welcome back to this very special show with a special guest, Sir Philip Hampton, the Chief of Royal Bank of Scotland, RBS. Sir Hampton, about the global economy now. How would you say the US economy may pan out? Do you think, at least by the way the markets are guessing and the way we've seen recent data, that at least a double-dip recession is out of the way?
I think a double-dip recession, which was being widely talked about 6 months ago, maybe 9 months ago, I think has become much less likely. But we're in very, very unprecedented territory. I mean, we've seen imbalances in the world economy before. We've not seen the scale of imbalances. We had twin deficits in America spectacularly for the times in the 1980s, but nothing like the levels of deficits, fiscal deficit and current account deficit that we're seeing in America now. One element of that, the current account deficit, is now being addressed, and the relative weakness of the dollar in recent months is now showing through in terms of the shrinking of the US current account deficit. US industry has become much more competitive, and that's what America does. It does actually adapt more quickly than most other economies. The fiscal deficit does look at the moment a little bit more intractable. It's obviously colossally high, but the US administration know that. And they'll be hoping that the restoration of growth in the economy will make a big impact in trying to reduce that.
You know, what we have seen over the last 24 months is a gigantic experiment in monetary policy, where all central banks, all major central banks, have tried to inflate a deflating economy. It's a little difficult to believe that after such a scale of imbalances and then extraordinary government action, things could come back to normalcy in 9 months. What do you think could be the imbalances? Where will they emerge? Will they emerge first and foremost as inflated assets?
The fundamental imbalance is really the big trading imbalance between the United States and China and the rest of the world in terms of trade. That's the one that's got to get fixed. That is the one that will get fixed either by some adjustment of currency over a period of time or by some other actions coming in to redress that balance. But it is inherently unstable. It has to be addressed in some way or other.
Yeah, because for the last 24 months, I think the renminbi or the dollar renminbi rate has remained at 6.82. There isn't immediately, at least, any signs that the Chinese will allow it to go anyway.
And the US government has been suggesting, putting pressure on, discussing this with the Chinese authorities, who are determined to keep their currency at very competitive levels. But it's extremely difficult for the US economy to sustain that rate of current account imbalance. At some stage or other, something will give.
How do you rate the growth in the Chinese economy? There seem to be two kinds of people. One set of experts who believe that the Chinese have been able to wriggle out of the problem of poor export demand, and the scorching pace of growth will more or less continue, double-digit growth at least. And there are others who believe that China is going to find itself in a problem because it's over-investing in assets which don't have users, and therefore there is a shell economy being created, and such imbalances can't last for long.
There are many aspects of the Chinese economy which are fundamentally very strong. They are extremely strong in manufacturing a whole range of products that are gobbled up by consumers all over the world at the moment, and it's a fantastic achievement that they have made. But it is not long-term a sustainable issue that they accumulate such enormous surpluses, and such an enormous surplus in particular with the world's principal economic power, the United States. So if there is one area of stimulus that we know least about, including, I think, the Chinese, it is the efforts to stimulate the Chinese economy to compensate for some of the downturns they've had in their export markets. The banking sector in China, in particular, is growing at a tremendous rate. The rate of loan growth in China is tremendous, well ahead of the rate of growth in the underlying economy. And that sometimes can characterize, in fact, it is not sustainable in any economy over any period of time. So at some stage or other, the loan growth will have to reduce in China. And we'll see what implications that has for Chinese growth as a whole. The banks are getting more capital into China in order to obviously sustain their own capital positions in the wake of this very, very strong loan growth.
you must be having some kind of assumption on what kind of growth you're seeing in the US and in the UK. Give us an idea of what is your idea. Would there be any contracting quarters in the next 8 quarters, say, or next 4 quarters in the US and the UK, or would there be at least modest growth?
No, I think the consensus is likely to be right. I don't always say that, but I do think the consensus is likely to be right, that there would be a relatively solid recovery taking place in the United States. I think we see evidence of that. It's not utterly convincing, but it's steadily building. I think the UK's rate of growth will lag behind that of the US. The sheer size of the financial services sector in the UK in relation to the rest of the economy is another fundamental issue which the United States doesn't have, or not to the same extent. But I think all of the major economies of the world will return to some level of growth over the course of 2010 and 2011.
It looks like smart money is headed to emerging markets. We have seen a goodish amount of dollar flows into all these countries, and that's already created problems for the real. The Brazilian real has had a huge amount of appreciation, and they've come in with the Tobin tax. Yes. Would you justify taxes like that? Because it's quite possible that 2010 will find other emerging markets similarly deluged.
As a general rule, I don't think taxes are a very good instrument for dealing with public policy issues. I mean, I think governments are better raising taxes in order to fund their expenditure. I want to think once they start directing taxes to try to achieve certain things, it is likely that unintended consequences will flow from that. So I think taxes always should be a last resort for governments to apply rather than a first resort. But it does seem to be a bit of a gathering trend that governments are tempted to use taxes in order to address particular parts of the economy. I personally regret that trend.
You know, we are at the start of a decade, a new decade. How do you see this decade shaping up, especially from an Indian standpoint? Do you think the global players will look very different by the time we are at 2020?
I'm extremely positive about India because, I mean, you know, like all countries, it's got lots of challenges, but the fundamentals of the Indian economy, I think, are very powerful. It's got an educated and growing labour force. Who are very competitive. It's got a very stable legal and business framework in which to do business. And I think it's increasingly liberal in terms of its attitude to developing those businesses. And it doesn't have the obvious chronic structural relationship issues that some other major economies do have. It actually is rather balanced. So, I mean, clearly there are major challenges of infrastructure and all sorts of other challenges in India that are obvious. But there's no reason why those challenges can't be addressed. It's very much within the power of people in India to address them. So I'm very positive about India, not just for the next 10 years, but for the next 100 years. I think it'll be a very strong economy.
On that positive note, Sir Philip Hampton, thank you very much for spending time for us.
Thank you.